This is a brief presentation on Radio Shack and financial statements, prepared for CIM 634. Radio Shack has come up a couple times in the news in the last couple weeks. Some of the article selections have mentioned Radio Shack, and they had an announcement a week or so ago that they were going to close 1,100 stores out of approximately 5,000 stores, which will leave them with approximately 4,000 stores remaining. It reported some losses for the fiscal year. So what I want to do with this presentation is sort of take you through Radio Shack's financial statements. The key thing I want to stress is what sort of we could know from looking at Radio Shack's financial statements, what's going on with the company, and sort of all this press that Radio Shack has generated with their announcement. This page on the screen here is from Radio Shack's homepage. If you look at it, very top of the screen, very top right, I Googled Radio Shack financials, and I was pretty quickly given a choice of Radio Shack's website, where they took me to their investor relations page where I can review their financial statements. They're a public company. They file financial statements. You can see sort of under the big red R, there's a whole big list of different reports I can have. I can have an overview of their news, their SEC filings, stock information, investor facts, etc. I can even have a contact people if I'm an investor and want to contact a company. So this is a typical investor relations page for a public company. What I want to note on this page is if you'll note under overview, they provide a couple things. They provide, as a PDF file is available, their 2012 annual report, so you can look at their 2012 annual report. We'll be looking at that in a minute. We'll also be looking at some of the information that was with their press release. This particular page was from March 4th at 10 o'clock in the morning, where they basically, actually March 6th, where they did an announcement on March 4th. The page is prepared on March 6th. And they did this announcement that said, hey, we're losing all this money, we're closing all these stores. And if you look at the little box in the middle right column, you'll see some information on their common stock. You'll see it closed the day at $2.25. It wasn't doing well to begin with. And it was down 47 cents for the day, which they say was down 17% for the day. So Radio Shack announces they're closing approximately 20% of their stores, and their stock falls 17% that day. So what this indicates is, one, that closing of the stores is not well received by the market. The second thing it indicates is that this was a surprise to the market. The market was not expecting Radio Shack to have this big loss and announce that they were closing all the stores because everybody owned their stocks sold that particular day. So now let's take a look at, these are the financial statements for 2012 and 2013. And I want to sort of bring you through to they have a 3 months ended, a quarterly for the last 3 months of the year. They also have a year-ended column. I want to bring you through for a moment to the year-ended column. Those are the last two columns. So we have 2013 and 2012. And what we see in terms of sales, in 2012, Radio Shack did $3.8 billion in sales. And in 2013, they did $3.4 billion in sales. So they dropped about $400 million in sales from year to year. If you look at their gross profit, which is the third line on the report, you'll see that their gross profit went from $1.47 billion to about $1.72 billion. So that dropped about $370 million or so. So sales go down 400 million, gross profit goes down 370 million. If you look at their operating expenses, and I'll just take a look at the total operating expenses, you see they're about the same. They've gone up a little bit for 2013, but they're essentially the same. So what you see is the operating loss line, and that's the line I really want to focus on. Right in the middle of the page, it says operating loss in parentheses and an income. For 2012, they lost over the year $25 million. And as a result of their sales going down this tremendous amount, they lost $344 million in 2013. So basically, if you look at this financial statement, you could pretty easily say, okay, they lost all these sales, they're not selling as much as they were, and that immediately translated into an operating loss. The two things here from a profit perspective that you might want to look at, their operating expenses are the same. They're selling 10% less approximately, yet their operating expenses are the same. This is usually the point where the boss comes around and says, hey, we have too many operating expenses in the business. We're going to have to let some people go. We're going to have to get rid of the company cars. We're going to have to fire a bunch of people, etc., to bring our operating expenses down. So what you see in Radio Shack is a decline in sales, significant decline in sales, approximately 10%. The gross profit declines pretty much in line with that decline in sales, and basically a decline in operating, and a therefore resulting operating loss for that amount of money. The other significant item here to note is if you look at the second line on the report, cost of goods sold. You'll see that they had in 2012, with $3.8 billion of sales, they had $3.2 billion worth of cost of goods sold. Cost of goods sales go down almost $400 million, yet cost of goods sold go down almost only about $100 million. So you see that all of a sudden they're selling the same products, if you will. They're getting less money for them. That's the other thing that this would indicate. So overall, the financial picture does not look pretty between 2012 and 2013. They lost money in 2012. They really lost money in 2013. The next thing I want to focus on a little bit here is this is their balance sheet. And you look at the balance sheet and analyze it, but the number I really want to focus on is the very first line on that balance sheet, and that's the cash position. In 2012, at the end of 2012, they had $535 million worth of cash. At the end of 2013, they had 179.8, which is 180. So they had $180 million of cash. So their sales went down $400 million. Their cash went down approximately $350 million. So basically, they had all this money. They didn't make sales in 2013, and they spent all their cash paying for their operating expenses and paying for inventory and other things. And they basically are running out of cash very rapidly as a company, as you can see by looking at these numbers. So that's the key number that I would look at on a balance sheet in this case. It says, hey, we have no cash left, or we have less than half the cash we had last year. And our sales all our sales losses translated right to a loss of cash. Now, these are the financial statements from the 2012 financial statements, and it shows their financial operations from 2008 all the way up to 2012. I want to focus on a couple different numbers here, just some summary numbers. So they give you revenue on the first line, they give you operating income or operating loss on the second line. So 2008, they did $4 billion worth of sales, made $300 million. 2009, they made $4 billion worth of sales, made $355 million in profit. 2010, they did $4.265 million worth of sales and made $350 million. So in 2010, you start to see a little bit of decline. They did $200 million more in sales than they did the prior year, and yet they made a little bit less money. So that's the first indication things aren't going well. In 2011, they did $4.3 billion worth of sales, so they increased their sales a little over $100 million. Oh, they only made $155 million from operations. So all of a sudden, they increased their sales a little over $100 million, and their profit was down by $200 million that year. In 2012, which is some of the similar numbers we saw in the other chart, their sales dropped back to basically back to where they were in 2010 when they made $350 million. But in 2012, at that sales level, they lost $61 million. Now, what I want to point out here is if we look at these financial statements, 2008 looks pretty good, 2009 looks pretty good, 2010 sales went up, profits went down. That one's tough to explain. What's going on at that point? That's where the boss should be running around saying, hey, what's going on with our expenses? What's going on with our sales? What's going on with our inventory? Why are sales increasing and profits declining? So all those people who sold the stock yesterday or last week when the stock price went down, or when they announced this big loss, if they'd looked at the financial statements in 2010, they probably could have seen this happening. You certainly see it start to happen in 2011. And you see very much the roots of it in 2012, and it finally manifests itself in 2013 with 2013 financials with this announcement in early 2014 that it's time to close all these stores. I would contend if you had actually been looking at their financials and analyzing them, you could have seen in 2010 that this was the direction they were headed. It clearly looks like it from the financial statements. The other item I want to point out, these are the same time periods. It's a cut and paste, so you can't quite see the years across the top. But I want to point out that each of the inventories, in 2012, they had 636 million of inventory, etc., 744 in 2011. By 2012, as their sales started to decline, they had $900 million worth of inventory. So they had $150 million worth of more inventory in 2012 than they had in 2011 as sales were declining. If you looked at this from a store perspective and you looked at the cash position, what you're basically seeing is Radio Shack stores are filled with a lot of things nobody wants to buy. They seem to have the wrong product mix. They're selling flip phones when people need smartphones, or they're selling computers when everybody has tablets. But basically their problem is the inventory they have in their stores does not match what people want to buy, and hence they have all this additional inventory that's been accumulated. The key part of this, and what I really want to stress here is, one, by looking at the financial statements for the company, you can actually see what's happening, and you can actually see it well ahead of time. Now, I would pose a question to everyone, and that question would be, if you're a district manager for Radio Shack, and here, let's say you're working in New England, and Radio Shack comes to you and says, hey, we'd like you to relocate, and we're going to put you in the Cincinnati, Ohio region, and we'd like you to move out to Cincinnati, pick your family up, and move to Cincinnati. Would you go? And the answer probably today would be, of course not, because I don't think the company is very solvent. I think you're closing all these stores. Why would I want to take and move my family across the country to this other region? The second half of that would be, if I'd asked you that question in 2012, would you have gone? If I'd asked you that question in 2010, would you have gone? A core piece of that decision for anyone probably should have been to look at the financial projections for the company. This is sort of like the interview question where we ask you where you're going to be in 5 years. The financial analysis of the company is a good way for you to ask the company where they're going to be in 5 years, because you can simply look at their financial statements and see which direction they're heading. Radio Shack is a big company. They have 5,000 stores. If you look a few years back, they had close to 8,000 stores. It takes a long time, if you will, for a big company to go broke, but you can see them on that path as they're going. And based on what these financials are showing, unless Radio Shack is able to effectively get its sales back up, get its inventory back down, it's still headed, and next year's announcement will be we're closing another 500 stores, and then we'll be down to 2,500, etc. So that's the pattern we see here. I just want to use this PowerPoint basically to describe what we see happening in Radio Shack's financials, and also use it as a lead-in to how you can actually analyze what's happening in a business using an analysis and some of the analysis tools to analyze the financial statements. This is the final piece of Radio Shack's report, and what's interesting, this is how they report their financial results. This is the press release they said to everybody, and what I want to point out, first line, they plan to close 1,100 underperforming stores. But they're getting strong sales growth in their concept stores. It doesn't really say how many concept stores they have, and it also says somebody willingly loaned them $835 million in the fourth quarter. So basically what this is saying from Radio Shack's perspective is this is how we're burying the bad news. We put out the bad news. 1,100 stores closed. Oh, by the way, our concept stores look good. Oh, by the way, somebody just loaned us money. Everything's looking good. So they leave you with this message. Bad news first, 2 pieces of good news. Very interesting way to put their press release together. And this piece is a summary of their fourth quarter results. And the interesting part of this fourth quarter results is there's so much data mucked up in these numbers, you have to really, really read it to understand what's going on. But if you do read it, it says comparable store sales were down 19%, driven by traffic declines and soft performance in the mobility business. They're basically saying people aren't buying the products we're selling. Store sales are down 19%. Okay, so they're going to close underperforming stores, but across the board their sales are down 20%, is what they're saying. So shutting some of those stores doesn't necessarily get you, doesn't necessarily get you the, doesn't reverse this sales trend, I guess would be my point. You'll also see on the third bullet there, selling, general, and administrative expenses were 41% of net sales compared to 32% of net sales in the prior year. So you can see pretty much that the company has some pretty bloated corporate overhead there that's also going to have to be dealt with. You know, you're in Radio Shack's corporate office. You went from 32% of sales to 41% of sales. Oh, and by the way, we just closed 1,100 stores. There's a bunch of people in there, probably close to 40%, who will not be there or should not be there if the company is set to survive. And the final point of this, and I want to point this out, the very last bullet, the company will close 1,100 stores which have been selected based on location, area demographics, lease life, and financial performance. So although the headline says underperforming stores, the actual strategy they list here has a bunch of other criteria. It's not just financial performance. It's area demographics. It's lease life. If they have a long-term lease, they probably can't get out of it, so they're probably going to be stuck keeping the store open. Location. Demographics is important. They want demographics that's going to meet whoever they think their customer is. So hence concluding my somewhat not so brief presentation on Radio Shack's financials and what they announced in the material. And you can look at any other company and do a similar analysis.